Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Hi, Don McDonald here, Tom Cock over there. Welcome to Talking Real Money, the show that most of the time disagrees with Dave Ramsey's investing advice. Most of the time. However, there is one piece of Dave Ramsey investing advice with which we agree.
We love Dave when it comes to annuities.
Annuities.
I love this quote. Dave isn't a fan of annuities, and there are plenty of reasons why. One of the main reasons is annuities have significant expenses that reduce the growth of your investment. And then the person writing this on behalf of the insurance industry says, an annuity is not an investment, it's an insurance contract. Well, that's kind of weird.
They pitch them as investments.
Investments all the time.
Indexed annuities actually went out of their way to allow themselves to be sold as investments without any regulation.
And this piece is lengthy. The reason we're talking about it is we both randomly ran into it on our Apple News feed.
And you know what?
And I read it and went, what?
Well, one, it's from Entrepreneur Magazine.
Yeah, that's right.
Respected publication.
Okay.
However, this article, boy, do I use that term loosely. This thing was written by a guy named John Rampton, who is the CEO and founder of a website called Due.com, D-U-E.com. It is a site that does nothing but sell, well, not nothing but, we'll get to that in a minute. It sells annuities. And nowhere in this article, Entrepreneur Magazine, nowhere does it say this is a commercial or an advertisement. This is so misleading. It is, it's infuriating.
Yeah. I mean, if you go through a point by point, some of the things they say are just misleading would be an understatement. They talk about how, well, yes, some annuities have high commissions, but not all of them. You could buy some with low commissions. And then they say you could buy mutual funds with high commission, sales charges as high as 8.5%, which I haven't seen in a long time.
We've seen higher than that on annuities.
Yeah.
And as a matter of fact, I don't think there are any more. There may be one or two, but the vast majority of mutual funds don't charge 8.5% anymore. This guy is flogging annuities, particularly. He calls them fixed annuities, but I think he's referring to indexed annuities.
He has to be.
He's saying they don't charge fees, and
right.
Yes, some have high commissions, but fixed rate and single premium annuities only have little tiny commissions. Well, not indexed annuities. I've seen them as high as 10. And this business about surrender charges, he makes it sound like the surrender charge is a good thing.
Right, and the fact that you can't access your money, the fact that, as Dave correctly points out, the growth of your investment, you call it whatever you like, the growth of your contract doesn't grow as fast as simply investing in a balanced stock and bond portfolio, which you can get at any time, which you can take out at any time, which, again, in many cases, when you roll these into these annuities, the money you take out comes out as regular income, which doesn't make sense. There's a lot.
Oh, well, let me give you this one. This one is over the top. This guy who is an irresponsible writer, just from this, he says, quote, annuity think tank gave a stellar example of two investors who had $100,000 to invest from 2000 through today, unquote, writes Rachel Summit for the Annuity FYI blog. Quote, the investor who had their money in the S&P 500 from October 2000 through October this year would have $90,000 right now. Now, the implication there, it's like you're thinking, wait, it says today, right? So you're thinking when the article was written. I went back and looked at that Annuity FYI article. That was written at the end of 2009.
Yeah, after a pretty tough bear market from
so that
about
was
a year over 2008.
Yeah, from 2000 to 2009, you would have lost money on the S&P 500. But they're saying a 10-year fixed annuity purchased in 2000 would have guaranteed 7%. I don't remember any that were paying that much.
Me either. I mean, look, shouldn't they just be happy enough with the fact that there've already been like $280 gazillion worth of annuities sold this year or something because people are scared to death by what's happened in the market? This is irresponsible, if you can call it journalism.
Yeah, no, it's not journalism. It's a commercial. It's an ad. An entrepreneur magazine? You should be ashamed. 855-935-TALK.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Real help for your real money issues is really here for you right now. It's right at hand. We're right here. Here we are.
Can I keep the R's coming?
Of course, I know you're going to insist on it. So
I know, because the biggest trade of the second quarter was
it was
the most profitable trade.
No,
Russian
I don't
ruble.
believe
the
in
Russian
trading
ruble.
Currency.
How was your ruble trade in the second quarter?
I don't
there?
trade. Plus, I wouldn't have bought rubles. Who knew?
48.6%. 48.6%.
I honestly hate it when you mention those things because people then start to think that they're investments. And I think I think we confuse people, and we don't want to do that. I think that people are easily confused when it comes to money. Okay. Oh, I should have gotten into those rubles, darn it. Yeah. Why didn't Tom and Don tell me to get into those in the first quarter?
Yeah, okay. Well, because you were probably stuck on the lean hogs that only made you 7%.
Well, as long as they keep propping them up, they'll do okay. I just don't want to fall over.
Watch that lean, my friend.
855-935-TALK is our phone number. Aaron, welcome to the program.
Hi, I have a question for you about fixed annuities. I called in just before you had this recent discussion on fixed annuities, so I'm a little hesitant to ask my question, but I'm going to go forward with it.
Go for it.
So I was offered a fixed annuity, 10-year, with a 30% pay up front. I did a 30% bonus.
Yeah.
My question is, if I have 40% of my money in a stable position anyway, is a fixed annuity comparable to, say, okay, for example, I'm in a Boeing 401k. I have some of my money in stable value.
We've heard of it.
Yeah, is that how would the fixed annuity compare to that if I got a 30% bump right up front? They said it's attached basically to the S&P 500. If the S&P 500 goes up, it goes up. There is a ceiling.
Yeah, this is not a fixed index annuity.
Index annuity.
This is an index annuity, and it's the Allianz 222 is the one I'm betting because that's been pushed a lot lately. This is a gimmick.
Okay, but let's talk about the difference. So a fixed annuity is you give a portion of your money to the insurance company. The contract is you get a certain interest rate, a certain payout for a period of time. I mean, that's the only annuity, by the way, I think you should ever buy. A fixed index annuity, which Don is now going to describe, is not a good product.
No, it's a good product if you like to be misled. If you like to be lied to by because I bet you they told you you're going to get return comparable to the S&P 500 with no risk, right?
Yeah, they showed a similar chart to what you talked about, 2000, starting in 2000. I know that.
And I bet they showed. I bet they showed that if you were in their annuity, you would have made more money than if you were in the S&P 500 because I know the chart and I know it well. I even have a copy of it here. I have a copy of the chart. That chart That chart is horribly misleading.
Okay, actually, it shows making a little bit less, and I think it's because the S&P 500 has gone up so much recently.
Right. But the reason it shows that it's even close, because it's not close. On a realistic basis, if you actually bought the S&P 500 in 2000 and held it to today versus that annuity, you would have made, well, hold on, I'll get you the number. But let me tell you why that chart is so misleading. I've seen the chart. I've been to the sales pitches. I've studied this more than probably anybody in the country.
You wrote a great paper on this, the actual construction of one
that
of these annuities.
chart does not include dividends. It's just the dollar value change of the S&P 500. It is, these people are such liars, sir. They are their pitches are bald-faced lies. Now, here's what if you would read the disclosure documents, I guarantee you will be so confused by this product, you will have no idea what you're buying. You will look at that and you'll go, I don't know what this is. I don't know what these caps are. I don't know what because it's not the actual S&P 500 that they follow. And the fact of the matter is that 30%, that's also a gimmick. They'll only add, I'm going to have you hang on because this is such an important topic, Aaron, that I don't want to stop. I don't want to stop right now. But, we still got time? Okay. Let me just tell you real quickly. What they're doing, that 30% does not get tacked on until the end. And it only gets tacked on if you annuitize it. So you don't actually get 30%. What they're in essence saying, it's a gimmick to make it appear you're getting a big chunk of money, but all you're going to get is a tiny little incremental increase in the income that they would have paid anyway. And so
where's the money going to come from to buy this contract?
I just hate these things.
Aaron?
So where's the money? I was going to come out of my, if I were to do it, it would have come out of my 401k.
Yeah, bingo. Bad idea.
These people. And let me just, one other thing. Let me tell you, if you had put $100,000 into the S&P 500 on January 1st, 2000 and held it to today with dividends, you would have made turned it into $431,000, which I am confident is about twice the number they showed you on their chart.
Okay.
I would run away from this person. I would never deal with this person again. This is a dishonest insurance salesman.
What is, and by the way, just out of curiosity, what is the first year surrender?
10% at least. I guarantee it. I can look it up.
I don't know what the first year surrender means.
Yeah, see, because they don't explain that stuff to people. Yeah, and if you tried to get out in the first year, they will charge you probably a 10% fee. Now, let me explain some of the things. When you do this, they either give you an annual point-to-point return of the S&P 500 with a cap, or an annual point-to-point with a spread, or an annual point-to-point with a participation rate. But all of those little things you don't understand mean is they're only going to give you a fraction of the return of the S&P 500. And that has in the past tended to average about 3.5%.
Which does not sound like the S&P, which over the long haul returns somewhere around 10%. And you can put the money if you wanted to. And by the way, I wouldn't take it from the stable value fund and put it in the S&P or this product. But they're in no way equivalent, stable value fund and an equity index annuity.
I got the surrenders, Tom. You ready?
How much?
10-year surrender, 10% the first year. If you try to get your money out the first year, it'll cost you 10% of your money. 10% the second year, 10% the third year, 8.75. 7.5.
How much are you going to put into this, Aaron, very quickly?
I'm not putting any into it.
I know, but how much anyway? Well,
that doesn't matter. It doesn't matter.
It's a big paycheck.
Because let me tell you what that 10% surrender tells me is their commission is 10%.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
I got to tell you, you people, you who sell these products should be absolutely ashamed of yourselves. You don't realize how horrible your lies are because you cost people a lot of money. You hurt people's lives with this garbage. I would have no issue if you told people the truth. If you told people the unvarnished truth. If you said, hey, let me tell you, Mr. Potential Client, I'm going to get an 8 to a 10% commission off of this. Let me tell you, Mr. Potential Client, if you want to get this money out in the first 10 years, it's going to cost you for the first 3 years, 10% of your money to get out. That's because they pay me a big fat commission and they got to earn it back. And by the way, sir, you will not get the return of the Standard & Poor's 500. You'll be lucky to get about half of it.
Well, less. I mean, because, again, when you looked at it the one time, it was more like 3%. And by the way, just the reason I was asking Aaron the amount was, let's just say, for example, that he was being pitched to take $100,000 out of his what formerly Boeing VIP and put it into this product. Mm-hmm. That person selling it is going to make $10,000 in one afternoon. Now, think how hard you'll work to make $10,000 in one. I would work pretty hard to make $10,000 in one. So they institutionally are so incentivized to move that kind of product that you can see why they work so hard at it and why they ignore these parts that they really, as you said, should disclose.
No. Why they lie? Because it's lying by omission. It's lying by omission. There is nothing any of you can do to convince me that these are good products until you start pitching them honestly. If you believe they're so good, then why don't you tell your clients the truth, the whole truth, and nothing but the truth? And why do you rely on all of this complexity, these caps with point-to-points on indexes that may or may not be the actual Standard & Poor's 500? Did you mention it didn't include dividends, your charts? Oh.
But it's not an investment.
Lying by omission. Right. And they fought. The insurance industry fought the Securities and Exchange Commission wanted to regulate these because they're sold as investments, and the insurance industry said, no, don't do that to us because they're insurance products. And so we get to be regulated by our wimpy, beholden to the insurance industry, insurance commissioners in many states. Oh, can you tell it makes me mad?
Yeah.
Do not buy an indexed annuity, a fixed index annuity, an equity index annuity.
They label them all.
They got all these complicated names to confuse you. Do not buy them. Ever. Ooh, Mark, thanks for calling. Welcome to Talking Real Money.
Hi, Don and Tom. Good afternoon. Hopefully this doesn't get you too excited. 2 questions about Vanguard and Avantis ETFs, one for the U.S. ETFs and one for the international ETFs. We have some cash to invest in our Vanguard taxable account and are looking to continue into the ETFs in the future. So I'd like to get your thoughts. On the domestic side, on the U.S. side, we currently have VOO and VTCLX already, but we're thinking that going forward we should invest in the broader U.S. market. We do have some VBR, so we are invested in small cap value. I've heard that you've mentioned both VTI and AVUS. VTI looks to have about 4,000 companies, while AVUS seems to have about 2,000. Any thoughts given that we have VOO and VTCLX?
Do you know VTCLX, Tom, is the Vanguard Tax Managed Capital Appreciation?
So that's the same thing again. I mean, again, you got a lot of overlap there if you own large companies and then you're just buying more large companies. Here's to step back because it sounds like you're trying to do a simple portfolio, but then sort of add a few things on at the end. Either A, do a portfolio that takes up 6 or 7 or 8 exchange traded funds and covers all those asset classes individually, right? Like VOO and VBR. Right?
Yeah.
Right. Or just own a very few. You could own, for example, the Vanguard 500, and then the Vanguard, the VBR, and then the Vanguard International. You could balance those, so then at least have some exposure to all those asset classes in a more simple way. Don?
Or I think an even simpler way to do it is just to buy something like VT and then tack on small cap value, both U.S. and international, which Avantis can get you both of those pretty easily.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Reality radio for a really great future. We're talking real money.
Once again, our phone number for a little help with money is 855-935-TALK, 855-935-8255.
No surprise that you got fireworks here on Independence Holiday weekend from Don McDonald. The fireworks are
I get very passionate about people being lied to in this industry, and I just mean blatantly lied to. Oh, you're getting a return of the stock market with no risk. No, you're not. That's not possible.
And you're not paying anything.
Oh, right. And you don't pay anything. Well, how do you get paid? Oh, the company pays me. Liar.
That's always a good one. That's a good one.
I mean, you're lying by omission. It's still a lie. All right. Anyway, the top of the hour, when we started the show, we were talking a little bit about how there's one thing we agree with Dave Ramsey on. Okay, we agree on getting your debt paid down. Yeah. And that was that annuities are pretty much, for most people, a bad idea, particularly indexed annuities. But it was what we were discussing was an article written in an article. Ooh, I use that very loosely.
Clear that up.
Written for Entrepreneur Magazine, probably as a paid article by a guy named John Rampton. John Rampton is a serial entrepreneur. Nothing wrong with that. I've been a serial entrepreneur. But he started a website, a business called DUE, D-U-E. It used to be an invoicing company that went out of business. Yeah. It went out of business. So now he's doing it as Do Investing or doing whatever, doing something. And there's a page on his website that says pricing. Now, his website is really, really opaque. It's not very clear about what you're getting. It says simple pricing. Basic is free for a lifetime. Whatever basic is, you get 1% interest on your money. Professionally managed funds, and a monthly payout. Okay? 1% interest on your money. Professionally managed funds. If you pay $10 a month, though, you get 3% interest on your money.
How can he do that?
I don't know. Guaranteed interest rate, professionally managed funds, a 30-minute welcome consultation, 24/7 support, priority support, 1 business day response, retirement analytics, monthly account statement, advance this and that. And the thing is the guy's only licensed to sell insurance. He's
and
not
where's
licensed
the money
to
custodian?
Well,
do they hold it?
It doesn't say, but here's what he says. He says you can invest with confidence that your money is being invested by trusted advisors. Your money is invested with BlackRock and Athos. Athos is a hedge fund.
Yeah.
You know exactly how much you'll get.
Know this, by the way?
I have no idea. Are there any risks associated with it in the Q&A or the FAQ? All investments involve risk, including possible loss of capital. While that's not our goal, we, like all investment companies, are required by law to say it. Well, one, I checked with the SEC and FINRA. This is not an investment company. So he's lying. There's already lies all over the place right here. And I just was really curious. So last week, when I read this article in Entrepreneur, I sent them a note. I sent a note to support@do.com, the only address I could find.
24/7
support.
They're there.
I said, hi, I looked at your $10 per month membership with a 3% guaranteed return. Mm-hmm. What exactly is that invested in? Who holds the assets? I didn't want to use the term custody because I thought that might confuse them. Mm-hmm. So I said, who holds the assets?
Who holds them? That's good. Yep.
I also noticed that the information further down the page mentions risk. How does a 3% guarantee come with risk? If it's guaranteed, how can there be risk? In other words, how do withdrawals work? Is the money liquid? Sorry if these are stupid questions, but your information is very confusing. The response? None. Crickets. White noise. Crickets.
Yeah.
Not a thing. Not a thing. You cannot find out with what insurance company.
Why don't you send them 10,000 to see what happens to it? Then we'll know.
Oh, there's an idea. Yeah, that's right on the top of my list. Yeah, and here's what's really interesting. There's an article about what is an annuity, and it says written by John Rampton, MBA.
Oh, yeah.
Okay, but wait. I went to his bio. His own bio that he wrote. He wrote the bio. Ready? Now it said written by John Rampton, MBA. And I'm not saying he should have great credits, but he did go on to say in his own bio that he never finished his MBA at Stanford.
And he lists it there?
He lists it there.
Wow.
But he didn't finish his MBAs. But he says he's an MBA. See, these kind of websites really concern me. You should call us if you're going to one of those, and we'll check it out for you. 855-935-TALK.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Anybody else you want to pick on today? Or
no, I think I'm done pretty much. But I did want to mention one more thing. During the break, I was going deeper into Do's website. They also offer
Wait, just to make sure I'm clear on this, you're going deeper into the doo-doo?
Into the doo-doo. Pretty much so.
Okay.
D-U-E,
Just
D-U-E, yeah.
I want to make sure.
He says, why choose Do for your custom pension program?
Oh, perfect. This to be continued because we will get an answer from them.
No,
eventually.
we won't. He's not going to answer.
Yeah, we will.
You think?
Well, we'll get something.
All right,
yeah,
we'll see.
will.
855-935-TALK. That's our phone number. Lots of time left. Give us a call. We'll talk about your money issues. And you can declare financial independence this weekend.
Oh, come on.
Jim, you're up next. Welcome to the show.
Holy mackerel, guys. Man, you even got my blood. Can you hear me?
Yeah.
Hello there. Can you hear me?
Yeah, absolutely. Got to get the blood pumping.
You team any Christmas, man. This is crazy listening to all this misinformation out there. So I'm glad you guys are here. I hope everyone's listening and taking notes. So here's my question for you. So I'm retired military. I'm on a TRICARE plan. I've got great medical coverage. I'm probably not going to claim the Medicare option. I did A, but do I need long-term care? What do I get from that, and what the pitfalls if I don't have it?
Wait, let's go back. Let's go back to the last hour and talk to Tim.
Yeah, no, I mean with TRICARE you get a lot of help.
TRICARE is
my
wonderful.
folks had TRICARE with my dad being a retired. And by the way, thank you for your service. So no, I don't think so.
No.
I mean, again, you could have somebody look at it, but man, that would be overkill in my book.
Yeah, you're right about Medicare. You take AA's free. You don't really need it because TRICARE covers you so darn well. And the other one, as we said in our previous hour or previous podcast, it's a personal thing. Financially, it only makes sense if you predicted properly.
Yep.
It makes perfect sense if you end up staying in a nursing home for 10 years. Makes great sense. But the reality is, and this is what the insurance companies count on, the reality is the average stay in a nursing home for someone who actually needs it is about 2 years. You either get better or you die most of the time.
Yeah.
Very few stay long periods of time, but they're the anecdotes that get touted by the insurance industry to sell the products.
Okay, so long-term care in a nutshell, and I'm sorry I missed your first hour. Long-term care in a nutshell is something that TRICARE will not pay for. And if I go to a nursing home and I hang out for a couple of years, I need something to pay for.
Yeah, they will not pay.
Right.
TRICARE will not pay for some of they will pay for some of the medical costs associated with, but not for past a certain period of time, not for the facilities themselves. So what as Tom and I said previously, what we're both doing is trying to save enough money that should one of us or our spouses our spouses need that, that we can pay it out of our money. And if it's just a horrible situation and we have to sell off all our assets, then we can go on Medicaid.
Okay, beautiful. Okay, that's what I need to hear. Yes, that was my plan. I just need to hear a couple smart guys tell me, that you're okay.
Yeah, I think.
Guys, keep up the great work, man. I love the passion, love the energy, and I learn something every time I listen to you. So right on.
Awesome.
And I appreciate your help today. Thanks.
Thank you so much.
And we appreciate the fact that we get to celebrate the birth of America on Monday, thanks to people like you that continue to defend this great country. So thank you for that.
Please continue to do it, even
and
in
by the
retirement.
way, I just want to go on the record here because you said something about spending all your assets down. We're going to take care of each other. We are not taking care of each other.
No, I meant me and my wife and me, or
okay.
your wife and
I'm
you.
going to write something up just to be clear that's not going to happen.
I am considering putting setting up some sort of a billing to my children for all of the good care I gave them.
Oh yeah, this goes back to the guy who used to tell me, "Well, you don't want to be a burden to your children." I said, "They've been
I do. They were a burden to me."
Come on. And by the way, as we've discussed previously, when the last one leaves, it will have been over 40 years.
Well, that's
of taking care
whose
of children
fault
at
is
my house.
that?
I suppose you're going to put that one on me now.
I'm pretty much going to put that one on you. Yeah, Grandpa. I'm putting that one on you.
But, yeah, Grandpa, Dad, it's all in.
Yeah. I mean the grandkids' aunt is like just a little older than they are.
It's hard to figure out. It's a map or something, diagram of some kind.
Yeah.
Anyway,
okay.
Yeah.
855-935-TALK is our phone number. 855-935-8255. We get questions that you call in. We also get questions that you send in at talkingrealmoney.com. And here's one of those.
This isn't the Kathy Wood one again.
No. Tom and Don, short and sweet. Other than being a single security versus a fund, what's the difference between TIPS and I-bonds?
There's not that much difference, actually, now that you mention it, because TIPS are issued by the U.S. government. TIPS do readjust every 6 months, depending on unforeseen inflation. I'm not sure I know exactly.
Well, I can tell you right now.
The I-bond interest rate change. And by the way, thank you for raising that, because you're mad about the fixed annuities, fixed income.
Yeah. You're mad about I-bonds.
No, because all they hear is, I'm going to make 9% a year.
No,
you're not.
You're going to make 9% annualized for 6 months.
Until October.
Right, when they reset.
Yeah. At maybe 5%. And then until next year when they reset at 3%. You do not get a 9-year guaranteed 30-year bond from the U.S. government. Might from Argentina or something, but you're not from the U.S. government. So please.
And the current rate on 10-year TIPS is like 4.3. So there's the 10-year, the 10-year,
which is probably underwater for the year. The TIPS fund.
Oh, the TIPS funds? I don't know. Let's check. We should check that out. I'll look it up.
DF. I used to know the one that Dimensional has.
Well, I'll find Vanguard's.
So, but I don't know the difference between those two in terms of how the interest rates are reset. They do sound very similar.
They're very similar, but they are reset differently. Vanguard Inflation Protected Securities is VAIPX, and year to date, you'd think with inflation it would have done really well. No, down 7.5%.
There you go.
And here's one of the differences. TIPS are traded publicly on a daily basis. You can buy and sell
large
TIPS.
institutions.
Right. I-bonds cannot be traded.
No.
And there's a downside. You cannot get out of an I-bond in the first year at all. Period.
And if you get out early, and after that, you give up interest.
For up to 5 years, if you get out early, you get hit. You lose 3 months of your return. So you do get hit with those, and they are not publicly traded. So it is a little bit like comparing apples and pears. You know, they're different. 855-935-TALK is our number. We'll return. You can call that number 24/7, by the way.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Let's say for a second you have been pitched some sort of an annuity product, and I can pretty much guarantee if you're being pitched an annuity product, you don't understand it. Probably even the person selling it to you doesn't understand it. So you can call us at 855-935-TALK, or if you'd like to just deal with this quietly and privately, you can set up an appointment with one of our advisors, and they will help you figure it out. Just go to Vestory.com, free, no obligation, Vestory.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.